All right, John Active here. I need you fully locked in for the next few minutes because what I'm about to show you is not speculation, it's not theory, and it's definitely not just another headline you scroll past and forget. This is a real, documented change happening right now that affects every single person with a bank account. On January 15th, 2026, the Federal Reserve quietly implemented a regulatory change that fundamentally alters the relationship between your money and the banking system. There was no panic, no emergency announcement on the news. Just a subtle but incredibly powerful rule change that went live. The reserve requirement for large U.S. commercial banks that the big players with more than $50 billion in assets was slashed from 10% all the way down to just 3%. Let that sink in for a moment. For every $100 you deposit into your bank account, the bank is now only required to hold $3 in actual physical reserves. $3. The other $97, that money can be loaned out, invested, used in complex financial instruments, or pledged as collateral multiple times over across the global financial system. Your cash is no longer just being stored safely in a vault. It's being actively leveraged in ways you might not even be aware of. Think about what this really means. The buffer, the safety net that was designed to protect depositors like you and me during times of financial stress, has just been reduced by 70%. This isn't a prediction of a crash. This isn't a rumor I picked up from some corner of the internet. This is a regulatory change that is already in effect right now. And it tells you something absolutely critical about what the Federal Reserve anticipates is coming down the line. They are proactively positioning the entire banking system for a major liquidity event. In this video, I'm going to break this all down for you, step by step, in plain English. We'll cover what reserve requirements actually are and why they exist in the first place. I'll explain why this specific change matters even more than the interest rate cuts and hikes that get all the media attention. We'll dig into what this new reality means for the safety of your deposits and the stability of your investment portfolio. And most importantly, I will walk you through 3 specific asymmetric positions you need to understand right now to navigate this new landscape. This isn't about spreading fear. This is about financial literacy. It's about understanding the rules of the game, especially while they are being rewritten right in front of our eyes. So please, remove all distractions. Turn off your notifications. This is information you need to have. Let's get into it. First, let's start with the basics. What exactly are reserve requirements? For decades, they have been a cornerstone of modern banking. The concept is simple. A central bank, like the Federal Reserve, mandates that commercial banks must hold a certain percentage of their customer deposits in reserve. This money cannot be loaned out or invested. It has to stay with the bank, either as cash in their vaults or as a deposit with the central bank itself. The primary purpose of this rule is to ensure that banks always have enough liquid cash on hand to meet customer withdrawal demands. If a bunch of people suddenly decide to pull their money out, the reserve is there to prevent the bank from collapsing because it loaned out too much. It's a fundamental tool for maintaining stability and public confidence in the financial system. Historically, this requirement in the United States has been around 10% for the largest banks. This was considered a reasonable buffer. But the change to 3% is a radical departure from that norm. A 70% reduction is not a minor tweak. It's a seismic shift in banking policy. So the big question is, why would they do this? Why now? The official line might be that it encourages lending and stimulates the economy. By freeing up that capital, banks can theoretically pump more money into the system through loans to businesses and individuals. But there's a much deeper story here. By drastically lowering the reserve requirement, the Fed is essentially injecting a massive amount of potential liquidity into the banking system without printing a single new dollar. They are unlocking trillions of dollars that were previously locked away in reserves, making that capital available for the banks to use. This suggests they are preparing for a scenario where banks will desperately need access to cash, a liquidity crisis. It's a preemptive move. They see trouble on the horizon and are trying to flood the system with liquidity to cushion the blow. So what does this mean for you, your savings and your investments? Well, first it means your money is working a lot harder for the bank than it is for you. That $97 of every 100 is generating profits for the bank, while the risk is quietly being transferred. While FDIC insurance does protect individual depositors up to $250,000, this change introduces a higher level of systemic risk. If a widespread crisis were to hit, one that puts strain on multiple large banks at once, a 3% reserve buffer is razor thin. It leaves very little room for error. The system as a whole becomes more fragile and more susceptible to shocks. Your portfolio could be indirectly exposed through bank stocks, financial ETFs, or other investments tied to the health of the banking sector. Now, for the most important part, what can you do? This isn't about pulling all your money out and hiding it under your mattress. It's about being strategic. Here are 3 key areas to focus on right now. First, diversify your assets beyond the traditional banking system. This doesn't just mean stocks and bonds. Consider assets that are not directly tied to the promises of a financial institution. This could include physical assets like precious metals, which have historically been a store of value during times of currency devaluation and financial instability. Second, understand your counterparty risk. Who is holding your assets? If all your wealth is concentrated in one or two large banks, you are exposed. Look at holding assets in different types of institutions, including smaller, well-capitalized regional banks or credit unions that might operate under different, more conservative models. Consider brokerage accounts and how your assets are held there. Third, explore asymmetric investments. These are positions where the potential upside is significantly greater than the potential downside. In a world of increasing financial fragility, certain assets are poised to perform exceptionally well during periods of volatility. This could involve option strategies that bet on increased market volatility, or investments in sectors that thrive during inflationary or deflationary shocks. It's about finding those opportunities where a small, calculated risk could yield a massive reward if the systemic risks we've discussed begin to unfold. This information is your starting point. The financial landscape has been altered, and the old rules no longer fully apply. It's your responsibility to understand these new dynamics and position yourself accordingly. This is how you move from being a passive participant to an active, informed investor who can protect and grow their wealth no matter what comes next. Have you ever wondered what actually happens to your money after you deposit it into a bank? Most of us think it just sits there, safe and sound, waiting for us. But that's not how the system works at all. The foundation of our entire modern financial world is something called fractional reserve banking, and it's a concept you were probably never taught in school. It's a system where banks don't actually keep all your deposited money in their vaults. Instead, they keep a small fraction of it and lend out the rest. Think about it this way. When you deposit your paycheck, the bank takes that money, holds onto a tiny piece of it, and then loans out the majority to someone else for a mortgage, a car loan, or a business venture. This process creates new money in the economy and fuels growth. When everything is running smoothly, when people are confident and loans are being paid back, this system works like a well-oiled machine. It expands the money supply, stimulates investment, and keeps the economy humming. But what happens when things go wrong? What happens when confidence disappears? That's when the system shows its true vulnerability. If a lot of people get nervous and try to withdraw their money all at once, what's known as a bank run, the bank simply won't have the cash on hand. Why? Because most of it has been lent out. This is where the reserve requirement comes in. It's supposed to be the safety net, the guardrail. The reserve requirement is the minimum percentage of deposits that a bank must hold in cash and cannot lend out. It's the liquidity buffer designed to handle everyday withdrawals and absorb moderate financial stress. For decades, this guardrail for large banks was set at 10%. So if you deposited $100, the bank had to keep at least $10 in reserve. It wasn't a perfect system, but it provided a certain level of stability. However, there's been a significant change that most people aren't even aware of. As of recently, that reserve requirement has been drastically reduced. It's now just 3%. Let's break down what that means in real, practical terms. If you deposit $100,000 into a major bank today, that bank is only required to keep $3,000 of your money in liquid cash. The other $97,000 is immediately put to work. It's injected straight into the financial machinery. It becomes loans for other people. It's used to buy securities. It gets tangled up in complex financial instruments like repos and derivatives. And here's the crucial point that often gets missed. That money you think is securely yours, sitting in your account, has actually been transformed. It's no longer just your asset. It's now part of someone else's debt. In fact, due to the way money is created through lending, your original deposit has likely been relent multiple times over, creating a complex web of credit throughout the economy. The scary part is what happens if depositors all decide they want their money back at the same time. The cash simply isn't there. It doesn't exist in the bank's vaults. The only thing standing between the system and total collapse in that scenario is emergency intervention from the central bank, like the Federal Reserve. They would have to step in and print massive amounts of new money to cover the shortfall. And here's the most important thing to understand. This is not a bug or a flaw in the system. This is the design. Our financial system is intentionally built on this foundation of credit and leverage, and with the reserve requirement now lower than ever, that design has just become significantly more fragile. It's a system that relies almost entirely on confidence. As long as we all believe our money is safe, the system works. But the moment that belief wavers, the entire structure is at risk. Knowing this doesn't mean you should panic, but it does mean you should be informed. Understanding how money is truly created and how the banking system operates is the first step toward making smarter financial decisions for yourself and your family. It's a fundamental piece of financial literacy that affects every single one of us, every single day. Thanks for watching, and if you found this explanation helpful, please consider subscribing for more insights into how our world really works.